Margin accounts are the heartbeat of market leverage. They're what allow investors to borrow against their own holdings, amplifying both opportunity and risk. When you open a brokerage account, you have two basic choices: a cash account or a margin account. In a cash account, you pay for everything in full. Simple, straightforward, no borrowing involved. In a margin account, you're using the broker's money to help finance your trades. The securities you buy become collateral for that loan. The rules governing this system come from Regulation T, issued by the Federal Reserve. Regulation T sets the initial margin requirement, the percentage of the purchase price that must come from the investor's own funds when securities are bought on credit. For most stocks, that requirement is 50%. So if an investor wants to buy $10,000 worth of stock, they must put up $5,000 of their own money, and the brokerage firm lends the rest. The minimum equity required to open a margin account is $2,000, but that's just the beginning. Once the account is open, it's subject to ongoing maintenance requirements, the minimum amount of equity that must be kept in the account to support the loan. The maintenance margin is usually set at 25% for long positions and 30% for short positions, though firms can require more. If the account's equity falls below that level, the customer receives a margin call, a demand to deposit additional cash or securities to restore the minimum balance. Let's look at the mechanics. In a long margin account, you borrow money from the broker to buy securities. Here's the equation you'll want to remember. Long market value minus debit balance equals equity. The long market value represents the total worth of the securities in the account. The debit balance is what's owed to the broker. The difference between them is the investor's equity. If stock prices rise, equity rises. If prices fall, equity falls. When the equity drops below the maintenance requirement, the firm will issue a margin call. In a short margin account, you borrow the securities themselves, selling them first, hoping to buy them back later at a lower price. Here, the key formula is credit balance minus short market value equals equity. The credit balance comes from the proceeds of the short sale plus the required margin deposit. As the stock price falls, the short market value declines and equity rises. That's how profits are made on the short side. But if the stock price rises, the short market value increases and equity shrinks, triggering a margin call if it falls too far. The concept of a short sale is simple but carries serious risk. When you short a stock, you're selling shares you don't own, borrowing them from another investor's account. You're betting the price will fall so you can buy them back cheaper later. If it does, you profit from the difference. But if the stock rises, your losses can, in theory, be unlimited because there's no ceiling on how high the price can go. That's why short selling can only be done in a margin account and why it requires at least 50% initial margin and 30% maintenance. It's also why certain rules protect against market manipulation through short selling. For example, the Regulation SO locate requirement. Before a short sale can occur, the broker-dealer must reasonably believe that the shares can be borrowed and delivered by settlement. There's also a closeout requirement, which forces firms to cover short positions in threshold securities that haven't delivered within a set number of days. In practice, this helps prevent naked, short selling, selling shares that don't exist or can't be delivered. You may also see short interest discussed in the context of market sentiment. Short interest measures how many shares of a stock have been sold short and not yet covered. When short interest is high, it means a lot of investors are betting against the stock. That might sound bearish, but it can also be a bullish indicator. Because eventually, those short sellers have to buy shares back to close their positions, creating potential upward pressure, what's known as a short squeeze. Now, not every security is marginable. New issues, mutual funds, and options, unless used as part of a hedge, must be paid for in full. Municipal bonds, corporate bonds, and stocks listed on major exchanges become marginable once they've been held for 30 days. For the Series 7, you'll often be asked to compute balances and equity under changing market conditions. For long accounts, remember, equity equals market value minus debit balance. For short accounts, remember, equity equals credit balance minus short market value. And for both, always remember, margin magnifies everything. Used carefully, margin can increase flexibility and opportunity. Used recklessly, it can unravel a portfolio overnight. That's the balance of leverage, the power to do more, and the responsibility to manage it. In the real world, seasoned investors use margin to enhance returns and short selling to hedge portfolios, not to gamble. In the exam world, margin is a set of ratios, rules, and formulas that test your ability to track equity, credit, and risk. And understanding it is part of understanding the heartbeat of modern trading, where borrowed money, borrowed shares, and borrowed time all move together in the rhythm of opportunity and risk. Next time, we'll look at investment companies and mutual funds, how they're structured, how they trade, and what they offer investors who'd rather own a basket of securities than one stock at a time.